There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. I'm so lucky today. Josh is back. Jared Blickery is back. We're going to go to him in a minute to get up to speed on the action, the details from today's session. I'm going to cover the major averages here. We saw the Dow kind of peak into the green in the last hour or so of trading, finishing higher by 114 points, about 0.25%. As we've been discussing, really investors kind of playing a little bit of a waiting game here today, waiting for economic data later this week, waiting for big cap tech earnings. The S&P 500 also managing to just in the last 15 minutes or so really going into the green, but not by much, not even a tenth of 1%, about 3.5 points. And the Nasdaq still finishing very slightly lower, briefly went into the green and then came back down again, off by about a tenth of 1%. Jared's got a closer look at today's action for us now.
Well, thank you, Julie. I got a deep dive into what's going on between the bears and the bulls. We're going to attack that with Josh in about 30 minutes. But today was kind of a ho-hum. We're up against some serious potential long-term resistance, but that's kind of beyond the scope of this bell hit right here. So I wanted to check volatility first, and we'll see if I can get that going. Here is a VIX. That's been hovering around 25 for a couple days. That is down from 60, so a significant improvement right there. We can also check out the 10-year T-note yield. That has been consolidating, but it's down a little bit today, another 5 basis points. Nothing too drastic, but let's check out the sector action and see what's going on in sector land. We have energy as the biggest large cap S&P 500 sector. That is up just 0.7 of a basis point. Right there with it is real estate, and then just slightly lower is utilities and healthcare. If you're noticing here, there's a very defensive theme to some of these leaders here. Also, the staples is another defensive sector, but it happens to be leading to the downside. It's more of an earnings story. Tech also in the red, although it had a huge, absolutely huge week last week, so mitigating some of that bullishness. Now here's the NASDAQ 100. You can see the Mag 7 a little bit more red than green. NVIDIA down 2%, but Alphabet, Amazon, each down a little bit less than 1%, though Apple and Meta and Tesla is slightly in the green. Just not a lot of outside leaders or laggards here. And we can see also in the leaders, and these are my market leaders that I like to follow, we're seeing a surge in biotechs today, and I got two of those in the upper left. Both XBI and IBB are biotech ETFs. And we got transportation, regional banks, value stocks. So really interesting mix of a little bit of growth there, because biotech is growth, and some value as well. To the downside, Bitcoin took a little bit of a tumble, cannabis leading down about 2%, and the Mag 7, we just covered that. I just want to show you, and I'll close with the ARK Innovation Fund components. We saw ARK have its best week since November of last year. So did the S&P, not the S&P 400, the S&P 600. That's the Russell 2000 equivalent in the S&Ps. So basically small caps and the large caps last week were outperforming, and today we're kind of seeing a mixed board here. I said we're going to leave off there, so I'll keep my word and send it back to you, Josh.
Thank you, Jared. Joining us now is Gaurav Malik, Chief Investment Officer at Palace Capital Advisors. Palace is a wealth management firm with more than $3 billion in assets under management. Gaurav, welcome to the show. You know, it was a relatively calmer day in the markets today, Gaurav, but listen, we've got plenty of market pros and strategists come on and tell us that, in all likelihood, they think volatility probably, not all in the rearview mirror. I'm curious, when you're talking to clients, Gaurav, right now, and you're walking them through these markets, what are you telling them? What's your advice?
I think our advice is that, right now risks are sort of evenly balanced. So this is not a time to be overly exposed to equities. Bonds have been a little bit more challenging as they've increasingly shown more positive correlation with equities in the most recent part. We still do like privates as a place to go and hide right now. We do think there is a lot of earnings improvement that's occurring in that segment, in that sector. And really, the next direction for markets is only going to come in the next 2-3 months. So, we have all these deadlines at play, what's going to occur with China. We have the pause that was for 90 days. That's not going to come out till July. In the meantime, let's look for the tea leaves, what's occurring with the South Korea, Japan, India deal. That might give us some idea about what is the framework the current administration is looking at in terms of reaching some conclusion to the current tariff situation. So I think it's a little bit about being balanced right now, not about being either too exposed to equities or too underexposed to equities, frankly, as well. This is about being balanced and more neutral across your holdings as you look out.
Gaurav, is there anything that you're seeing that is less exposed across the different asset classes that you think, if volatility persists or even worsens with regard to tariffs, might be a better place to increase a bit of allocation?
I mean, we do like, utilities and healthcare. So I know there's still some noise about what exactly is going to occur on the tariff situation with healthcare. But I do think that healthcare is likely to benefit potentially from just the cash it generates. So it has the ability to fund its growth much more easily than other sectors do. We are seeing a move occurring across, especially big pharma, more focused on innovation. So I think those things we do like. Utilities, again, as you think about the AI theme playing out, there's going to be a constant need of energy. The government is going to continue spending money on infrastructure upgrades. So we like that sector. And then we're beginning to eye the financial sector. So here the trade-off for us is that, of course, the earnings have been pretty solid for the first quarter. Large banks do tend to make a lot more money in volatile environments where volatility spikes, and there is kind of the trading-oriented businesses that do really well. And if volatility is calm and markets are behaving well, then it's the asset and wealth management side that does really, really well in those areas. Plus, that's a space where we do think deregulation is going to come through strong. I mean, all the commentary we've heard from especially Scott Bessent over the last few weeks around deregulation, around relaxing how they treat treasury securities within bank portfolios, all points to some improvement in the sentiment around those sectors. So I think those are places we continue to look at as we look at the next few months.
Gaurav, we have big tech earnings on deck this week, Meta, Microsoft, Amazon, Apple. I'm just curious, your thoughts on what you've learned so far during this earnings season.
Well, I mean, the earnings season has been, I mean, on balance, it's been actually quite reasonable. I mean, in general, we think that most companies are surprised on the upside, at a 7.5% so far. What's been reported for the S&P is in line, slightly ahead of expectations. Also, we're getting some more comfort that perhaps companies do have levers. While they're not opining around what exactly they're going to do in a tariff situation, we're getting some sense of the earnings season that these companies are all tuned up with the classic levers they have. And I think the easy ones are cut back on discretionary spending, cut back on travel. Still there is labor to play with, right? That they could potentially think about labor cuts, layoffs and things like that occurring to balance and keep margins really, really high. And almost every company still continues to invest and think about AI as a theme to improve productivity across the board. So I think some encouraging signs as you look across the earnings season, but obviously nobody's willing to make an opinion one way or the other as to what's going to occur with the tariff situation. We're just looking for companies that are building up their defenses. Again, more cash on hands, more flexibility with labor. Those are the areas that we've sort of our big takeaways from this earnings season, and there are companies that are doing a good job of that.
And where does the consumer fit into all of this? Because we've definitely seen the sentiment surveys go south here. Do you expect any kind of feed through to actual consumer spending? And if so, how significant is that hit going to be? Yeah.
So that continues to play on our minds. I mean, we'll see the GDP report that comes out, later this week. That'll give us a sense of sort of what Q1 was really like. It's a bit of a catch-22. If labor markets are weak, if there is a raft of, if there's a weakness that occurs in employment, well, then the Fed is forced to basically change its reactive function to move away from inflation to protecting labor markets and spur some growth. So there is that side to think about, which does help the consumer out. But I think it's more sentiment right now. Consumer balance sheets are still in reasonable shape. There was a pickup for sure as you look through the banking earnings on how much reserves they're holding for credit losses, delinquencies, but still very contained in my view. So if the specter of tariffs isn't if the worst scenarios don't play out, then I think basically we look to ride out this quarter and hope for a stronger consumer as you look at the latter half of the year.
Gaurav, thank you so much. Appreciate it.
You're welcome.
Well, signs of an economic slowdown are materializing at U.S. ports. Yahoo Finance markets reporter Josh Shaver joining us now with a closer look at the numbers on the traffic and what we're seeing so far.
Yeah, so this has been an interesting one, Julie, because you kind of have these moments in the economic narrative where the data isn't necessarily telling the story that people feel like is out there in terms of right now. We feel like there's perhaps an economic slowdown, maybe already happening or coming, but when you look a lot of the other high frequency data, you're not really seeing that, right? And so one thing economists have been highlighting over the past week is data from the Port of Los Angeles. So what we're seeing from data from the Port of Los Angeles, as far as weekly scheduled containers coming into that port, what you're looking at here is year-over-year growth. So you can see a big spike for that week that included April 20. Then you're seeing a large move down. So this is what a lot of economists have been talking about. They think we're going to see once we get more April data, which is maybe you had a lot of spending in March, then it sort of falls off a cliff to some extent, right? Because you had a lot of people essentially ordering before the tariffs come in. Now the question is, of course, what does that mean for the overall economy when you start to see this slowing down? And you actually recently spoke to Ryan Peterson from Flexport. He's the Flexport founder and CEO, and I thought he explained this rather well, so I want to take a listen to what he had to say.
If it comes way back down, then it'll be okay. Companies will rebook those containers and start moving the goods again. If it lasts a few more weeks, certainly a few more months, you're going to start to see shortages. You're going to start to see bankruptcies, unemployment, and really just a large-scale recession like we haven't seen in many, many years.
So the it there that Ryan's referring to is tariffs, right? And he's saying if tariff rates don't come down soon, you're going to continue to have this issue. And then sort of the economic way that this issue spins out, right, guys, is if less things are coming into the U.S., then things that are here likely get more expensive. If things that are here likely get more expensive, then my money doesn't go as far, right? So I probably buy less. Well, if I buy less, then maybe at some point the companies that are selling me stuff say, I need less employees. And then you get your unemployment rise, and that's sort of how the cycle works. So right now, it's just a few weeks. We're just looking at shipment data, but it's one actual sign of literal economic activity that is slowing that I think we're going to be increasingly talking about in the weeks to come.
That's one indicator, Josh.
Yep.
But there's other key indicators folks look at, and you write about this. Like you talk about like weekly filings for unemployment benefits. I mean, what are those saying?
Yeah, so the weekly filings for unemployment, Josh, right now are really not telling you much, right? You've been sitting at about 220,000 for feels like a little bit over a month now. But what I think is interesting is just, again, to think about sort of how this works. It's probably going to take several months for those to start picking up, right? In terms of actual layoffs, you would need to see your business actually slow. And right now, even when you think about corporate earnings calls and what we're hearing from companies, it's not that their business has already slowed. They're worried about it slowing in a couple months, right? So is the layoff cycle a late summer layoff cycle, right? And that's sort of the cool down period that you see. Because again, you need to have a reason to lay people off, right? People don't just want to get rid of workers to get rid of them. You need to have some pressures that actually start to materialize. So it seems like that part of the story might actually be a little bit later. For instance, the jobs report this Friday isn't necessarily supposed to be that bad, at least from expectations.
Small businesses maybe will feel this first because
Yes.
they have less cushion. And we also could be in the interesting situation where even if, say, a month from now a trade deal is announced, it doesn't mean the tariffs will come down immediately. Or even if they do, it takes a while to sort of feed through the system. So you could be in a situation where you get economic data that is deteriorating, but the market's going up because it's seeing those trade deals maybe coming through.
Right.
I mean, not that that's unusual, right? The market's a discounting
yeah, and the market's
mechanism,
going to look forward.
But still,
right. Yeah.
It'll feel a little discordant if that's how it plays out.
Yeah, definitely. And I think to your point, when do the actual rates come down? Right? I think it's sort of the looming question. Not talk about de-escalating, but when does the actual de-escalation
Exactly.
happen?
Yeah.
Thank you, Joshua. Appreciate it. Stick around. Much more market domination overtime still to come.
Treasury Secretary Scott Bessent saying it's, quote, up to China to de-escalate the trade battle. As progress on the trade war between the U.S. and China remains to be seen, we're looking at the implications for China's future role in supply chains. Rhodium Group senior analyst Lauren D. Piper is joining us now to discuss. Lauren, thanks for being here. Obviously, we don't know how this is all going to play out. But in the meantime, companies are trying to move things around to try to change their reliance on supply chains, to try to change what their supply chains look like. How quickly is this adaptation taking place?
Thank you so much for having me. I think you're exactly right. Companies are desperately trying to shift their supply chains. But how quickly this happens really depends on the sector. China is by far the world's dominant producer across sectors like even apparel to solar panels to electronics and automotives. And for a lot of sectors and a lot of companies, right now there's just not enough manufacturing capacity outside of China to quickly shift production. And this is why, as you guys were talking about earlier, we're seeing some slowdown in container shipping coming to the US soon. It's possible that in the long run, some of these supply chains could change, but it's going to depend on where these tariffs ultimately fall.
Lorna, I'm curious, what do you think the odds are ultimately of a grand bargain being reached between Trump and Xi? And what do you think such a grand bargain could actually look like?
I think some sort of grand bargain is possible. Right now, 145% tariffs on China for most sectors is just, it's a trade embargo. It's not sustainable. So I think most likely what we're going to see is that the tariff rates are going to come down, but they're most likely going to remain elevated. And so the most important thing to watch, and what's going to matter for global supply chains, is the difference between tariffs imposed on China versus other countries like Vietnam or India. If there's not much of a difference, we may not see supply chains shift that much. But if tariffs on China remain elevated compared to these other countries, it will create enough of an incentive for companies to move their supply chains out of China.
Lauren, we've been focused on the semiconductor supply chains in particular, but also the sort of export bans that we've seen from the U.S. imposed on the ability of companies like NVIDIA to sell into China. We then got a report today, of course, that Huawei was going to be developing some chips that would compete with the chips that had been banned for sale in China. So as we watch that develop in the sort of homegrown technology industry in China, does it end up giving that industry a boost, or does it end up holding it back?
These tariffs and the trade policy the Trump administration is pushing forward, it could incentivize China to double down on its self-sufficiency goals, as seen with Huawei and its development of its homegrown chips. I think these tariffs the U.S. has imposed has really made clear to China that the U.S. is committed to doing more restrictive trade measures, and that the trade relationship is going to worsen. So I think that China will double down on developing these homegrown technologies on the sort of self-sufficiency push that we've seen China work on for the past decade or so.
Lauren, what is your sense of sort of the health and resilience of the overall Chinese economy right now? You know, Barron's had a good piece about this, pointing out it was of course sputtering and then seemed to be just kind of finding its footing. And now we have, of course, new tariff and trade tensions. But I'm interested in your take.
Absolutely. As I'm sure you know, China's economy is heavily reliant on exports. And so these tariffs pose a pretty significant risk. And that's why a lot of Chinese companies are already reporting up that they're pretty concerned about their prospects. Ultimately, the impact that this has on China's economy is going to depend on where the tariff rates fall and how long they stay up for. And it's something that we'll be watching.
What sector or sectors are you watching most closely, Lauren, as this is all playing out?
A handful of sectors. First and foremost is some of the consumer goods sectors where 145% tariff just is not sustainable for a U.S. consumer. So, for example, in apparel, even though it's a sector that's, you think of as one that relies on low-cost labor, China is still a major producer of apparel products. And now with the tariffs going on, we see some major apparel producers like Shein announcing price increases of up to 377%. And so looking at sectors like this is going to be really interesting to see just how long U.S. consumers are willing to take these higher prices and how that affects the Trump administration's willingness to maintain such high tariffs.
Lauren, great to have you on the show today. Thanks so much for your time.
Thank you.
General Motors gearing up to report first quarter results Tuesday morning. The latest results come as automakers we know grapple with President Trump's auto tariffs, and Yahoo Finance's Praz Subramanian joins us now with a closer look. Praz.
The big question here is, are they going to keep maintain guidance, right? Which is, I don't think, going to happen, right? So they issued full year guidance at the end of last quarter, assuming they made the assumption that no tariffs and the EV tax credits remain in place. Obviously, we have tariffs. Tax credit's still there. It's a big change there. So, how does that adjust that prior guidance? They're talking about 13.7 to 15.7 billion in EBIT. That was that projection, similar to last year. But analysts of all stripes think this is not going to remain in place because of the fact that they have a heavy exposure to places like Mexico, Canada, and even South Korea for some of their cheaper cars like the Trax and the Trailblazers. So we're going to keep an eye on that. And just high level numbers: revenue 43 billion or thereabouts, adjusted EPS $2.72.
Remind us, Pras, where GM is in the EV landscape at this point and in its EV journey, if you will.
You know, their EV journey has evolved. They were kind of criticized for slow rolling that out, right? And now they have basically EVs in every segment, from pickups to small cars like the Equinox EV, even the Corvette, the Corvette E-Ray that's electrified, not full EV, but it's electrified, right? So they have a kind of a wide swath of EV products, and those sales have been doing quite well, but you know, they're still losing money on these cars, and they have a profit path of sort of, you know, a variable profit on EVs coming up that they want to hit, and I think they actually hit that last quarter. But you know, it's one of these profitability metrics that are, you know, yes, made money, but there's a huge, heavy investment there with the fixed costs.
Switching gears, Ford's board declaring a dividend for second quarter 25.
Very interesting. I just got this alert here, 15 cents a share here. They don't report earnings till May 5th. And normally they declare the dividends on the day they report earnings. Who's reporting tomorrow? GM. Who might suspend it? Who could potentially suspend a dividend, pull guidance? GM, right? Is this sort of rubbing a little salt in the wound that might come up tomorrow? I'm not saying it's going to happen, but I think it's very interesting timing that they're declaring this dividend right now. Well, they don't have earnings till next week.
Right, and the stock, by the way, is not doing anything in reaction to this. So
I'm just saying, not trying to say anything's going to happen, but I thought it's really interesting.
Interesting timing. We'll wait and see. Thank you,
I like
Pras.
interesting things, you know.
who doesn't?
Yeah.
Time now for What to Watch Tuesday, April 29th, sponsored by Tasty Trade. We're going to start off on the earnings front. It's another big week of earnings with Coca-Cola, Visa, and General Motors headlining tomorrow's results. Coca-Cola announcing first quarter earnings before the opening bell. Analysts expecting to see slower earnings growth in Q1, but profits could rise slightly. Higher prices are helping boost sales, but that benefit is fading as consumers pull back. Investors will also be listening closely for any commentary on tariffs and guidance on the earnings call.
Also taking a look at the labor force, the monthly job openings and labor turnover survey JOLTS, as we call it, coming out in the morning. Economists forecast job openings will have dipped slightly in March to 7.5 million, signaling a slight cooling in a historically strong labor market.
And moving over to some economic data, we're going to be getting April's consumer confidence report in the morning. That number expected to fall to 87.6, suggesting that consumers are feeling less positive about the state of the economy.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.